Assalamualaikum and welcome to chapter 9 with the topic of portfolio management. In the part 1 of this chapter, we will cover 3 learning objectives. The first one is to explain diversification and concept of portfolio to reduce risk. The second learning objective is to calculate the portfolio expected rate of return. And the third one is to calculate the portfolio risk or volatility. So in finance, diversification can be described as not putting all your eggs in one basket. It is a risk management strategy that makes a wide variety of investment within a portfolio. A diversified portfolio can contain a mix of different asset types in an attempt at limiting exposure to any single asset or risk. The rationale behind this technique is to smooth out the risk in a portfolio, where the positive performance of some investment can neutralize the negative performance of others. Diversification in portfolio holdings not only limited across different asset classes, like what illustrated here, where you can invest in bonds, in stocks, or maybe in real estate. Diversification can also be within asset classes. Now, for example, if you invest in stocks, maybe you will invest in different companies from different sectors. Okay. Example, you invest in company A, B, diversification can also involve geographically, okay, where you invest in both domestic and foreign market. Now, you must know that calculating expected return is not limited to calculation for a single investment asset or security, like I have shown you in the previous chapter. It can also be calculated for a portfolio. As a well-informed investor, you naturally want to know the expected return of your portfolio, its anticipated performance, and the overall profit or loss it's raking up. So the basic expected return of portfolio formula involves multiplying each security's weight in the portfolio by its expected return, and then adding all those figures together as shown in the example in this slide. Okay, where you multiply the weight of security A with the expected return of security A, add with weight for security B, multiply with return from security B, and so on. Fundamentally, an investor bases the estimates of the expected return of a security on the assumption that what has been proven true in the past will continue to be proven true in the future. That is why expected return for each security in the portfolio is commonly measured using probability or historical data. You can recall this from my video for chapter 8. The weight of each security in the portfolio, on the other hand, can be determined by taking the value of each of the securities and dividing it with the total value of the securities. Once the expected return of each security is known and the weight of each security has been calculated, an investor can simply multiply the expected return of each security by the weight of the same security and sum up the product of each security. So if you look at in the example here in this slide, if you want to find the weight of each security, okay, from a total fund of 10,000, 2,000 invested in A, 5,000 invested in B, and 3,000 invested in C. So therefore, you can get the weight here by dividing the proportion of fund invested in A. I give you example here. Example 2,000 divided by the total amount of fund of 10,000. And therefore, you get the first weight of 0.2, which is 20%. Okay, and you can find the rest from this example. After calculating the expected rate of return of a portfolio, now we are going to calculate the risk of a portfolio using the standard deviation of the portfolio returns. Portfolio standard deviation basically refers to the volatility of the portfolio, or simply the amount of the investment returns that deviate from the mean of the probability distribution of investment. There are three important factors that include in the calculation of standard deviation of portfolio. The first one is the proportion or weight of the portfolio invested in each asset. Okay, this is the first one. The second factor, the respective standard deviation of that individual asset in total portfolio. Okay. And the third one is the correlation between each pairs of asset of the portfolio. So these are the three factors involved in calculating portfolio standard deviation. So here is the formula of a standard deviation of a two asset portfolio. Okay, this one is the formula, which is calculated by squaring the weight of the first asset and multiplying it with the variance of the first asset, added to the square of the weight of the second asset, multiplied by the variance of the second asset, then add this value to 2 multiplied by the weight of the first asset and the second asset, multiplied by the correlation coefficient of the return between the first and the second asset, and multiplied by the standard deviation of return from each asset. Finally, take the square root. Take the square root of the value, and the portfolio standard deviation can be calculated. You may realize just now that in order to get the final figure of the portfolio standard deviation, correlation coefficient between the two assets need to be identified. Here, okay, this is the symbol, row symbol for correlation coefficient. Okay, and to find this correlation coefficient, you can use this formula. By finding covariance, okay, this is the covariance between the two assets and divided with the standard deviation of both assets. You can refer below here on how to calculate covariance of the two assets, either by using historical data or you use finding covariance using probability. This correlation coefficient can range from -1 to 1. So a -1 correlation indicates perfect negative correlation, where the return of the two assets move perfectly in opposite direction. meaning if return of asset 1 goes up, return of asset 2 will definitely goes down. While a correlation coefficient of 1, which is perfect positive correlation, means that the return of the two assets move exactly together, either up or down. So I hope that you can see that the concept of correlation coefficient is important to your understanding of managing portfolio risk through diversification. As long as the return of each asset are not perfectly positively correlated, there will be diversification benefit to your portfolio. However, the diversification benefits will be greater, or your portfolio risk will reduce further when the correlation are low or negative between each of the assets in the portfolio. This slide illustrates the correlation coefficient between the returns of two assets. Either it is positively correlated or negatively correlated, or can be no correlation. Okay, so this correlation coefficient can range from strong correlation, moderate correlation, until weak correlation. Let us go through one example on portfolio standard deviation for two asset portfolio. Zachary is your friend. A year back, he started following the stock. In a finance article published in a magazine in those days, he read that the not all eggs in one basket approach to investing is useful because it helps reduce risk. He started a portfolio with RM2000, invested 50% in stock A, which is Bumi Armada, an energy company, and 50% in stock B, ARB Berhad, an information technology firm. Following statistics relate to these two investments. So in this question, they gave you return for both company, okay, 7% for Armada and 50% for ARB, and also the standard deviation for Armada and ARB Berhad. Notice here that this question also provide you with the correlation coefficient between returns of Armada and ARB, which is 0.6. So if you want to calculate the portfolio standard deviation for these two assets, okay, remember the formula from the previous slide. You have to find the weighted portfolio standard deviation first, where 50% equally invested in stock A as well as in stock B. Okay, and you have to multiply with the standard deviation of stock A, which is 10%, and also standard deviation of stock B, 20%. So you get 15%. Then you can proceed by calculating the portfolio standard deviation, which includes the correlation coefficient in the formula. Okay, so you use the formula like previous slide, okay, where you square the weight and also the standard deviation for each of the asset, and then you add with 2 multiplied with the weight for stock A and also stock B, multiplied with the standard deviation of A and standard deviation of stock B, and also multiplied with the correlation coefficient. Okay, and then when you square root, you will get this final answer. Before we end, I would like to show you the formula for portfolio standard deviation of 3 asset portfolio. Notice from this formula that you need to determine all the 3 components, which include the weight, standard deviation for each of the 3 assets, as well as the correlation coefficient for all the possible pairs of combination from the 3 assets in the portfolio. Where in this case, you need to find correlation between asset A and B, asset B and C. You need to find the correlation for B and C, and also correlation for asset A and C. So just imagine if you have to calculate the standard deviation of portfolio of more than 3 assets manually. It would consume a lot of your time and effort, since calculating this involves a multi-step process. Therefore, you can always use up any relevant software such as Excel to fasten your process in finding the figures needed. Okay, thank you for now. I'll see you next week for the second part of this chapter. Assalamualaikum.